Welcome back to the Financial Shepherd podcast. My name is Joshua Casey Garland, certified financial planning professional, founder and CEO of Shepherd Wealth Management. Very excited to be back here on the microphone for today's podcast. There's a ton to cover, so much to talk about. I don't even know how we're going to get it all in today's program. So we'll be brief with our early morning comments here. I know that I'm sitting on my third cup of coffee. I've been jacked up since about 6 a.m. today. Looking and gathering all this information and trying to deliver it in a concise format. So I'm going to be all over the place, if you will, a little bit. But happy Thursday, man. We're at the middle of March, basically.
Yeah, happy Thursday. I'm feeling the March Madness and the midweek. Of course, it's not hump day, but it could be in our minds,
No doubt. And I got a little neighborhood bracket pool going here. So
Awesome.
Very excited to participate in that and very likely lose, given that most of the time, in my experience, people win. Like my wife, they just basically pick their favorite mascot, and that's kind of how they do things. So
That's how it goes, isn't it?
So yeah, that is not a way for me to build wealth for my future, is doing March Madness brackets. But
Yeah.
Hey, good luck to all those that do participate. And funny little story, because I can talk about this now. I couldn't talk about it back in the day, at least not in on a podcast. But as a Fidelity employee, there was a zero tolerance policy for brackets. If you had a March Madness bracket sitting on your desk, they would walk your ass out. And it has a lot to do with the fact that they don't want to be, construed as, gambling. They work in finance. They take things very, very seriously. They're very, very good professionals over there. And they're not the only one. That's just my personal experience. But it was weird. I thought it was weird, given that everybody participates in that, like office pools and all this sort of stuff.
Yeah.
But that wasn't true necessarily at other places I worked at. And now that I'm doing this thing now, it's fun to have that little bit of fun and freedom to do that. So glad to talk about it. Just wasn't something I was allowed to do. A little fun little nugget there.
Yeah. As you're aware, I don't really have any friends, so I don't have anybody to do the bracket pools with.
Hey, welcome to ours, man. It's a partial age bracket, but
I appreciate it. I might hop in there. I might have to just put down your house as a residence on my new license just to be able to qualify for that bracket challenge. But the last like just hardcore one I was in was a long time ago. But when I was in grad school at LSU, they were pretty good and made the Final Four, which definitely dates my time there. But
yeah,
it got wild, man. I mean, it was like involving professors and undergrad students and I mean, the pot was just insane. It was seriously like it was thousands of dollars. There were so many people in it for like $20, a bracket. And of course, the person who won was just like, I don't give a care. I love the color yellow, and like move the yellow jerseys into it. So
yeah, it's kind of the way that some people pick horses, and that works out sometimes too. But if you
yeah.
do win the neighborhood party, as I'm gonna have to take a small commish.
Oh yeah, I'll give you finder's fee for sure. For sure. That horse is, I like to go into when they're warming up, and if the horse like defecates while it's getting ready, I bet on that one because it's just like cracking to go,
That's not a bad way to do it either. But
It works.
that's coming up too. April is Keeneland season, so we both went to the University of Kentucky. We both are familiar with all the fun things there. So we'll talk about that too as we get into spring. I'm feeling allergies already.
Oh yeah.
I'm a Claritin guy. Already got that out of the way here this morning. So hopefully no sniffles.
Team Allegra over here.
all the same difference. But yeah, so much to get into today. Have to keep the fun stuff a little brief. So we'll start with our usual questions. So we got a couple questions. And the reason why we do these things, one is I get a lot of questions and I like to address them on this program. So if you're a fan of the show, drop those questions to us, right in YouTube Live, or just text 513-630-2664. Happy to take those questions. Or you can email us. Just go to shepherdwm.com. You'll find all of our contact information there. And I also like to provide some real life perspective of meetings that I have with our customers and prospects and some of the things they ask me. So we're going to kick off the show with something unique here. So there's this concept, or I wouldn't say a concept, I'd say more of an opportunity that I think a lot of investors across the United States are missing out on within their own company's retirement programs. This has nothing to do with Shepherd Wealth Management, acquiring additional customers, et cetera. But what I'm getting at is most individual investors are either unfamiliar with or afraid of what we call a self-directed brokerage account within a 401k. Now, this is not offered everywhere. This is so. First of all, with 401ks, if you are a employee and your employer provides you a 401k benefit package, that employer is paying for that benefit. They're paying Fidelity or Vanguard or whoever it may be, the custodian, to have that platform for the employees. That means that the employer also gets to make decisions with that 401k plan, such as, are we going to allow Roth contributions to this plan as opposed to just pre-tax? Are we going to offer only one mutual fund family, like a Vanguard fund family, versus like opening up to a whole bunch of different funds? Are we going to allow loans against the program? All this different stuff. Those are all rules that are essentially created by the employer. Now they have to follow legal rules from ERISA plans that govern 401k types of programs, but essentially the employer gets to make all these decisions because they're paying for it. And the more bells and whistles they add to it, generally the more expensive that 401k benefit is. But most employers these days provide that. So here's the deal. A lot of you either didn't pay attention because you're excited about your new job and maybe you're a great engineer and you want to focus on your engineering and you know that you're not going to retire for 30 years. So that thing is way off into the future. I'm going to participate in it. I'm going to get my full match, and that's great. But what you guys need to pay a little bit more attention to when you're enrolling or when you have these open enrollment periods is those benefits can change. The employer can add things, it can subtract things. It's your job to pay attention to it. It's their job to provide you with some sort of retirement benefit plan, or otherwise, you're just going to leave and go find someplace else that not only pays you well, but also provides nice benefit packages, such as things like 401ks. So what is a self-directed brokerage account? Most of you have them. Most large 401k providers these days are offering a self-directed brokerage option within a 401k. Now, why are they doing that? It's because the job labor market's super tight. I don't need to convince anybody of that. Everybody knows that the labor market's very tight, and the only way to attract and retain great talent, well, you can pay them, but you can also give them great benefits as well. And part of those benefits is providing a self-directed brokerage account inside the 401k. So what is this? So you get the 401k, right? This is Ezra's Vanguard 401k. Well, what your employer can also can provide is, of course, the matching. So you get 100% match up to 6%. So you're getting a full 6% match. So if Ezra puts in 6% of his gross paycheck, he's also going to get 6% match by his employer. Awesome. Self-directed brokerage account. Within that 401k, if you have a self-directed brokerage account option, what that means is you're setting up a brokerage account within that Vanguard 401k in this example. So a brokerage account, for those that are unfamiliar with the terminology, a brokerage account is just like setting up an individual account or a trust account or a joint account. It's a taxable account. But this is within the 401k. They're calling it a brokerage account because Vanguard is a broker in this example, just like Fidelity is a broker, Charles Schwab is a broker. So inside of this Vanguard 401k, if you have this self-directed brokerage option, you're setting up a brokerage account still at Vanguard, still held within the 401k, so everything is tax sheltered. The difference being, now that you're in a 401k self-directed brokerage account, now you have access to the entire market. You're not stuck with just one fund family or a group of fund family. You can literally invest in almost any mutual fund you want to. You can invest in any individual stock that you want to. In most cases, any individual bond, corporate treasury, CDs, basically whatever you can invest in inside of an individual account at Vanguard or Fidelity or Charles Schwab, or pick your custodian. You can own those types of things inside of a self-directed brokerage account, which is getting all of the same benefits: tax sheltered growth, after or before tax contributions into those 401k accounts. You're just setting up an individual brokerage account within the 401k. Most of you have this as an option. Why is this important? Is because if you're just buying funds blindly, there's a really good chance that, number one, you've over diversified yourself, meaning that you're not protecting yourself anymore when the market goes down. but you're limiting the upside growth opportunities by buying individual stocks along with maybe some ETFs allows you to prevent a lot of that overlap and duplication of work. By the way, if you're using only funds, funds charge an internal expense ratio known as a fee that you don't see on your statement, but it is in fact the cost of owning those types of positions. By owning individual stocks, you eliminate that because you don't have to pay for trades these days at places like Schwab, Vanguard, Fidelity, and pick your favorite custodian. This is a huge advantage. This is exactly what I did when I was an employee at TD Ameritrade. I had this option, and I significantly was able to generate a lot more in return. And ultimately, because of those decisions, that allowed me to create this business that I have here today. It took every dollar of it, and I'm very thankful for those decisions, and I'm thankful for the opportunity to have something like a self-directed brokerage account option while I was an employee at TD Ameritrade. So for all of those that maybe looking at their personal financial situation right now due to tax season, take a look at that option. Most of you have them, and take advantage of it. If you're not familiar with it or uncomfortable about it, give us a call. This is what we do here, 513-630-2664. So just a little nugget there for all of you folks out there kind of reevaluating your personal financial situation. And I bet a lot of you had no clue what a self-directed brokerage account even was or is. So why hire a certified financial planner? Number one, I just dropped some knowledge on you cats that you probably didn't know about. And number two, so I got asked this question by a very smart individual yesterday. He's in the medical profession, extremely smart, extremely well respected within the community and the anesthesia community. And the question was, well, why hire a CFP? Well, number one, I was able to point out to him something like a self-directed brokerage account. So that's kind of where that question came from today that I wanted to address with the audience. But the main reason is because we provide confidence more than anything else. And I gave him the perfect example. So he's in anesthesia as part of his medical training, extensive training, of course, to get into that kind of field in medicine. And I said, hey, can you kind of tell me about your day? He's like, well, yeah, we had, 30 people come in yesterday to do hip replacements, and I had to put them down. And I'm like, wow, 30 people. It kind of sounds like you're just like filling in cavities at a dentist office. Like they're cranking through those things as fast as they can through a day. I was like, hip surgery, wow. That many in a day. He's like, yeah, the next day we got 50 of them. I was like, okay, so if I'm one of those patients and I'm just nervous, right? I got to go under, you guys are going to do something to my body. I got to take these shots. There's a whole bunch of physical therapy afterwards and this and that. Like that makes me nauseous just hearing you tell me that you guys are going through 30 new hips, one day, 50 the next day. And how do you deal with that? He was like, well, I've been, trained and this is what the doctor says is necessary for this medical procedure. It's going to last this long. And because of all that training, I'm confident in knowing what I need to do. I was like, there's your key word, confident. When you look at your personal financial situation on a scale of 1 to 10, how confident are you? I think it's more like less than 5. And this is an extremely smart individual. But the thing is, they're extremely smart in the gifts that they've been God-given. I mean, I'm sure he worked extremely hard to be able to get through school and all that. There's some stick-to-itiveness to that. You guys get what I'm saying? And he had to obviously have, the ability to want to work hard. But he found the thing some point in time in his life, could have been early on. I didn't ask the question, but he realized that he was really good at maybe math and science specifically. And as he continued to go through that, he recognized that more and more like, hey, this is a gift. I enjoy this. I understand this. Whereas me, I'm sitting there in, chemistry class and stuff is way over my head. This guy can memorize the periodic table and tell you everything about every element and atom and proton that goes along with it, right? It's just his God-given gift that he was willing to work hard towards, whether he knew it or not. And that's what gave him this opportunity to do. He doesn't thank God for it because I can't do that, right? It's not anything that I want to do at all. I'm not comfortable with it. Even if I could intellectually get through all the schooling that it would take to do that is not something that I'm comfortable with in any way, shape, or form. But all of the training that I have gives me confidence to tell this very extremely smart, well-trained individual in his field how to make more prudent financial decisions that ultimately will put you in a much better place in the short, intermediate, and long term. So it's providing confidence to individual families and households and employers, because we obviously work with business owners here as well, giving them the confidence, because the number one financial stress in individuals' lives is the number one stress that individuals have in their personal life is their personal financial situation, according to Capital One surveys. 74% of Americans say that. So I'll always have, opportunities to work with individuals, households, and business owners in that regard, because it is such a high stress thing. And it's because it's not your area of expertise. And that's okay. There's nothing wrong with that. We as a society have this very much lone wolf mentality. And what I mean by that is, hey, I'm going to pick myself up by my bootstraps. We know how dumb that sounds. Like, physics would say that's impossible. Like, if your ass is on the ground with legs out and you try to literally pull yourself up from the boot, it's impossible. You cannot do it. We need to get over the fact that we're supposed to be able to, run a 4-minute mile, 6-pack abs, a Ferrari in the driveway, and, $1 million or whatever the thing is, right? Forget about all that. Just focus on whatever it is that you're great at or good at, and try to become a little bit better at it. Makes you happy. If you're doing the stuff that makes you happy, it's very likely it's the stuff that you were God-given blessed with. You applied yourself towards, which is going to make you happy. And in general, in my experience personally, and in the lives that I've been able to be around with other people, when they do those things, they generally make more money. It's not 100% of the time, but shit, even if you didn't make more money, you're going to be happy. And then, what's the price of being happy?
Or at least
Right?
when you do find yourself in those proverbial holes where you got to dig yourself out of, you you have enough care and enough you know yeah, you just care enough about continuing where you're at, and getting yourself out of it. You don't just like kind of sit there. You're like, well, no, I'm going to fix this. And like you said,
Yeah.
nobody can do it alone. So, you look for the ways out of it.
Yeah. It's just a society thing. It's a, stubbornness. It could be, you pick your adjective, right? But we just kind of need to recognize that as individuals is we can't be great at everything.
Well, it's
There's
the
a
difference
reason
between
why.
advertising and real life. It's the stuff that
Right.
we just get sold. So we turn the TV on or buy a specific piece of merchandise or clothing. It's not real life. It's these unattainable things that, you can't ever quite get to this perfection. So you're just going to keep shelling out your money and your attention span to it, you know?
Exactly right. I mean, I'm not saying I don't like nice stuff. Don't get me wrong. Like, I do. If you like all
That's
that,
not what we're
great.
saying. Buy once, cry once. That's my life. I like buying nice stuff that lasts forever.
I like that. I mean, if you can be, an astronaut and an accountant and, an engineer all wrapped up, God bless you, man. That's great that you have all those skills. Now, that's not most people.
No, that's like
Um,
the pinnacle of human existence. If you're an astronaut, like you're the greatest of the great. Like
yeah.
basically LeBron James and Einstein put together.
You can, I can go on and on, but I'll leave it with this. You can look at all the statistics of your favorite celebrity athlete. There's all, lottery winners. You can see what happens after they massive amount of success and wealth, but just for a little bit of time, and then it all went away. So we don't need to belabor the point there, but that's the main X factor, that we bring to the table. There's a reason why, you don't pull up a YouTube video and figure out how to give anesthesia to yourself, right?
Right.
We don't need to beat the dead horse here, but I think you guys get the picture as to the value that we certainly bring to the table here. And that's why we love the show. And not just to give you these little nuggets of conversations that I have with, clients, prospects, but also because the news doesn't talk about this stuff. They do a really good job of capturing your attention, tapping into the emotions that individual humans have. We're hardwired with these things called fear and greed. We haven't changed all that much as human beings over the last couple thousand years. We've gotten a lot better at technology and innovation and manufacturing and all that stuff. But as core humans, how we go about making decisions, specifically with what we call stressful topics like money, we haven't changed all that much at all. And the news knows that. That's why they're pretty easily able to placate the individual emotions through their news headlines. And that's great to be aware of them because we all have very busy lives. We have these phones that make us aware, notificate us of, if that's a word, of all the news events, but it does not do a good job. The news does not do a good job of giving you historical precedents about what humans have done under similar circumstances. And that's really how we go about doing things here at Shepherd Wealth Management. We want to understand the risk, but also what have humans done under very similar circumstances. That way we can start to put probabilities in our favor, knowing that these things happen um, under these same circumstances. Here's what the risk was. Here's how humans behaved, and here's what the performance was of the 11 sectors of the S&P over the next 6, 9, 12 months. So that's how we formulate our asset allocation, which drives your performance. And it also is a way for us to keep control over our temperament or our emotions, which is the number one thing that prevents individual investors, according to Buffett, from achieving the types of results that they're looking for consistently. So that's why we do this show, and we're excited to be able to bring this information to you all today. But I'm going to kick us off with something that's more of a surprise. Not going to be a huge part of today's conversation. Oh, by the way, I'm a Barron's subscriber, and the headline Barron's here. So this is like the front cover. It's got a big bullhorn going through a piece of paper that says "Bet on the Bull." So when we start to see stuff like that in Barron's, you kind of almost feel like a correction of some sorts getting ready to happen, because everybody else and your brothers getting the same information. But in this Barron's article, like I said, I'm going to be all over the place today, as we got a little bit of news. So Vanguard CEO, surprisingly, is deciding to resign. Gentleman named CEO Tim Buckley. Buckley is 55, announced on February 29th, so recently, that he would leave the company at the end of the year. Buckley and Vanguard had given no warning, offered little explanation, and have declined interview requests. Buckley's tenure at 6 years has been relatively brief, but notable. Assets under management surged by more than 80% of his tenure to 8.7 trillion with a T. At the same time, though, customer complaints about technology and service quality moved to the forefront. Quote, "I'm crossing my fingers that Buckley's replacement makes the website, app, and customer service world-class." A customer posted in Boggleheads, which is a large and outspoken online community of investors that follows the philosophy of Vanguard's iconic former CEO, John Bogle. For those of you who don't know who John Bogle is now dead, rest in peace. But he's the founder of Vanguard. He's the founder of index investing. So there wasn't an index to invest in until John Bogle created it, which turned Vanguard into the massive, massive company that it is today, 8.7 trillion, as we just quoted here from the Barron's article. But the interesting thing here, and I've known this for a while because working at competitors, Fidelity, TD Ameritrade, is that Vanguard, although offers some low-cost investment vehicles, such as their index funds and indexed ETFs, they offer very little in the way of technology. As it mentions here, the app, the online trading platform is not great at all. Can't even compare it to a Fidelity or a Schwab or, a lot of other players for that matter, which is interesting because they are in a index type of ecosystem. All these boggleheads are, as the article quoted here, those are Vogel enthusiasts that truly believe to their core of index investing that all information is fully priced into every security around the world at all times, because every human being gets all this information at the same time equally. Therefore, markets are 100% efficient. I can point to a million examples to prove as to why that's not true. And, I think Vanguard has to admit some of that themselves, that they were being very honest, and that they have actively managed funds that try to solve for some of those mispricings at times, that things are not perfectly priced at all times. But they offer Vanguard as an entity, as this article is very directly pointing out here, it's a big company, and it offers some, like I said, very low cost products to get access to the markets, which is good for those, as Buffett said, diversification is for those that don't know what they're doing. If you're one of those folks that's unwilling or unable or can't get over your own ego, and you're not going to hire a certified financial planner, but you recognize that you're too busy to develop a process for your investments that consistently gives you the best probability of achieving the results that you deserve and look and need to be able to achieve the type of lifestyle you want both now and to the future, you're better off just buying the index. Keep buying it, dollar cost average it. You're going to get the market return. You're going to be happy with that over a long period of time. Markets average about 10%. But that also means that you go through periods where you're not so happy if you're just blindly buying the overall market, like years like 2022, and we can go on through history and point to times where that wasn't that great. But more often than not, you tend to do a little bit better than actively managed funds. Why is that? Is because actively managed mutual funds are generally pigeonholed into what they're allowed to invest in. They're either a small cap fund or a value fund or a growth fund. Well, if your flavor is popular that year, you did great. Great, you're a 4 or 5 star fund. The very next year, when growth is no longer in vogue and all of a sudden defensive things are the things that perform the best, that value four fund, 4 star manager, 5 star manager that did great last year is going to do terrible that year when their asset class is not in vogue. So that's generally why the index does better than actively managed funds, is because people don't point out in the statistics that those actively managed funds are in fact handcuffed to what they're allowed to invest in. It's known as a prospectus. None of you read them. They're very long, which is why I'm dropping these nuggets on you guys. So I thought this was interesting when I saw it. It's the first time I've seen a major article kind of let their customer base raise some concerns on a company as well known and respected as Vanguard. But I've known this for a while. Like their technology, their trading platform, their mobile app. I mean, you can't. I mean, it's at the bottom of the barrel. It's kind of hanging out there around the Ed Jones platform. If I had to compare it to something very similar, so there you go. As far as that's concerned, but it's still an $8.7 trillion privately held company, which is massive. Now, outside of the interesting Vanguard notes there, I did want to jump to outside of Barron's for just a second here. There's a Reuters article, and I'll give you the title of it. The title is U.S. Stocks May Not Be in a Bubble, but a Pullback Could Be Near. This was written by Lewis, I can't pronounce his last name, but March 13th, 2024. So this is fresh information. This is actually written at 1:07 a.m., oddly enough. Obviously, this guy's putting the hours here. But here we go. So we're going to quote this. Some investors believe the market's nearly uninterrupted ascent means a pullback is due. The last time the S&P slid more than 5% was October of last year, though Bank of America data shows such sell-offs historically occur 3 times per year on average. The index, the S&P index, is up 8.5% this year. So the market is doing great year to date, obviously. We were calling for double-digit returns this year. For those that have been watching the show, reading our newsletters that we send out on a monthly basis, you can find that stuff on shepherdwm.com. We have weekly blogs for our customers. We also post on the website. So you don't have to just take our word for it, but we've been talking about this is a great year for likely double-digit types of returns. I have some additional data I'm going to share with you guys in just a second that continues that support. But here's the dichotomy I think that we're in. So from a macroeconomic perspective, earnings have been fantastic. We do anticipate, at least the market's pricing in some Fed interest rate cuts later on this year. Instead of pricing in 6 cuts like it did at the beginning of the year, we're pricing in about 3 cuts right now. So if we expect rates to come down and earnings to hold up and unemployment to mainly be right around 4% or less, right now we're at 3.9%, those are great recipes for a tremendous stock market year for 2024. However, as this article highlights here, we haven't had a pullback of 5% or more in quite some time. And historically, we see 3 of these per year on average. We haven't had one of them yet. We had one day, I think the market was down about 2%. We got all that back within 48 hours, right? And if we do have a 5+% type of pullback, I would expect that we would get all that back and then some before the end of the year. We are very, very bullish for our customers on 2024. But with the type of rise that we've seen here over the last several months, I think that it would be prudent if we had some sort of pause with all this growth. But we just have not seen it yet, even on the back of a hot CPI print in January and another hot CPI print that we just got here for February. Today at 8:30 this morning, we got PPI, that producer price index, which is essentially a wholesale index. That also came in hotter than anticipated. and the market really hasn't budged. I mean, we're slightly down across the board on all the major averages. Russell's taking it on the chin the most, the small cap Russell 2000. Mostly due to the fact that interest rates went up just a little bit here today based on the hotter than expected PPI, followed with CPI news preceding that. And it's interesting. So we've gotten a market that's done great in the face of a little bit higher rates and interest rates that have now been pushed back as far as rate cuts are concerned. So I wouldn't be too surprised if we saw some sort of consolidation of the market. It's called a 5 to 10% type of move towards the downside. But if it was 5%, like history would say, based on where we're trading at today, that would put the S&P 500 just under 4,900. And if you look at things like moving averages, we're looking at pretty good support up until about 50, 60 on the S&P 500. So anything that falls below than that might actually trigger that 5%-ish type of pullback to somewhere around 4,900 based on, if you're looking at charts and you're a technical analyst. So it's something that we're keeping our eye on. We've raised a lot of cash for customers recently, and we're sitting on a little less than 50% on cash on average, some a little less, some a little more. So we have quite a bit of cash, but we're still being able to keep up with the market. So what that tells our customers as we move into a new quarter here is we have the right positions. We've overrated slightly the right things. We're just sitting on cash waiting for an opportunity like a minor pullback as a great way to buy the market in the stuff that we like the best, expecting unemployment to remain right around where it is right now. We're expecting earnings to continue to hold up, and we're expecting a Fed to eventually cut rates. And if we get this opportunity to buy the market at a lower price than where we're at today, it's certainly something that I'm going to be taking advantage of for our customers. I'm thankful that we've been able to keep up with the market performance, despite the fact that we're sitting on all this cash. So that's been great. But it's also a signal that we've done the research correctly, got the right types of positions and asset classes that deserve to be overweighted in this environment. Just kind of waiting on this moment in time where human beings decide to go ahead and sell some shares, kind of like what history has to say here. So we have that buying moment. So we're definitely anxious to buy that dip. But right now, we're trying to be as patient and prudent as possible before we get in there and do that. Now, from a March perspective, so we came off of this data from, as I just mentioned here, this Reuters article that kind of gave us some historical perspective on, it's fine to see the market move like this, but generally speaking, you see a couple of these 2-3 times a year of 5% types of pullbacks. Haven't seen it yet, so we're waiting for that. But that kind of flies in the face of the next data point here. So this is coming from Mark Newton at Fundstrat, huge fans of Fundstrat, very thankful for the work that they do. And I'm going to give you some of his data points here from a historical perspective. And here we go. So while February of 2024 wildly outperformed normal election year tendencies, it's worth just showing the seasonality chart of election years to illustrate that March can often be much better than the average February. Following 4 straight months of gains, a seasonal slide could be possible at some point between March and May, kind of like what that Reuters article was talking about. However, I'm not willing to bet on it just yet. For now, it's still right to expect higher gains in March, as this has proven to be the 6th best year in performance in election years. He goes on to say, interestingly enough, each time this has happened, so we got November, December, January, and February, last 4 months, have all been positive, a feat that's only happened on 16 prior occasions over the last 90 years. Interestingly enough, each time this has happened, the entire year has shown positive returns for a perfect record of 16-0. Moreover, the average return from March until year end has averaged 15.5. So from March to year end, we've had November, December, January, and February all be positive 16 out of 16 times over 90 years. We have positive returns from March on through the rest of the year, and that averaged 15.5. The median return was 14.6. March's average return in those 16 years, where the prior 4 months showed consecutive gains, was also positive 2.2%, which is much higher than the average return for March being about 0.4% specifically during election years. So I know that there's a lot of historical data that would suggest that when we've had great market starts to the year, multiple consecutive months of positive returns, generally you see three types of 5% pullbacks in a year. We're prepared for that. But I'm also looking at this data that FundStrat's putting out here and saying, hey, when you get those 4 consecutive years, it's been perfect 16-0 record that human beings buy the market. And we need to be participants in the market, no question about it, which is why we're not sitting on more cash. I have zero concerns with recession, given that the unemployment numbers remain very resilient and corporate profits remain very robust. So when people are employed, and that's 70% of our market is consumers buying stuff, people are going to buy stuff. But they also tend to buy the market as well, despite the fact that we've had 4 consecutive months of positive returns. I'm not saying that we're not due for some sort of consolidation, some sort of pullback in the market. I am actually preparing for that for our customers as we speak here. But it's been hard sitting on this cash and trying to be patient. I'm looking at all these data sets. One says we're due for some sort of pullback, and history supports all that. But also we're looking at this very strong data that suggests that we're likely to see very strong gains from now on for the rest of the year, outside of some sort of black swan event that we can't predict, which to me would be some sort of geopolitical shock, right, where oil prices all of a sudden spike above $120 per barrel from where we're at today. Like something like that out of left field could obviously happen in any freaking market year. I understand all that. But if you just look at the data sets, it is a little conflicting. And I think that's why markets are a little conflicted right now, because we're sandwiched with these 2 data sets in the face of a Fed meeting coming up next Wednesday on March 20th. And we don't really know what Jerome Powell is going to say. He's been fairly dovish so far. So there's a lot of push and pull going on in the marketplace here. I kind of can see us going down to sideways between now and earnings season, which will kick off sometime around the second week of April. And that's the reason why we're being just a little bit more cautious. But we can be cautious because we did the smart thing with our asset allocation. We positioned it in such a way that gave us a great chance of keeping pace with the S&P while we're sitting on all this cash, looking for that moment in time that history would say there's a great buying opportunity, knowing that the rest of the year historically should be very, very good. Lastly, probability of rates. So I'm looking at the CME groups, Fed Watcher, anybody can pull this up. They have a little countdown. The next FOMC meeting, the Fed meeting, like I said, is in 6 days, 2 hours and 36 minutes and 57 seconds as I'm giving this to you guys. Now, the probability of a rate cut on March 20th next week is basically 0. I don't think anybody expects that. The Fed told everybody that they're not going to be cutting rates in March already. Now, the probability of a May cut, which is where I've been hanging my hat most of the year, those probabilities have dropped dramatically. So we're looking at maybe like a 6% chance at the moment of a rate cut in May. The thing is, though, we're going to get at least a couple inflation prints and at least a couple job reports before we get to May. So we'll see what happens with these probabilities. Most market participants are betting on a June rate cut. So the rate cut probability for June is about 54% at the moment. So it's really still almost a coin flip. This is what I'm talking about here with investors stuck in this range. So I'm not saying the S&P can't drift higher than NASDAQ or any of that stuff in the short term. But if we got a few weeks to go between when Jerome Powell talks next week and our next earnings season, I'd have to be willing to at least be open-minded enough, knowing these 2 historical data points. We have to have historically some sort of market pullback. And also history would say markets tend to do very well under these sorts of circumstances. Then I have to be a little bit prepared for both. And that's kind of how we're settling things right now for our customers. And this is also a big reason why we do our quarterly reviews. That way we can hold ourselves accountable to performance standards or expectations that our clients have for us, given their personal goals. But we also want to communicate with them, not only this information, but our expectations, of what we would anticipate happening over the next quarter before we get to our next quarterly review. Now, we just talked about the Fed rate probabilities, but there's also another article here in Barron's. So I told you I'm kind of all over the place today, Ez.
Do it, man.
Where we got some pretty smart people calling for interest rates to come down. Now, I expect the same thing. We actually bought a position Ticker symbol is TLT. It's an ETF. It's the iShares 20-year, government bond ETF. And the only reason why you buy something like this would be, to me, is you're expecting interest rates to come down. As interest rates come down, the value of those long-term bonds goes up, meaning that you're going to make money on the capital appreciation of that ETF. And there's an interview here with David Kelly. He's the chief global strategist at JP Morgan Asset Management. He looks like a very smart guy. Good runner too, apparently. He's running his 6th Boston Marathon coming up here. But he was asked about monetary policy, which is what we just got done talking about here, Fed rate cuts. And the question from the Barron's writer was this: monetary policy will be center stage again this year. What are you expecting? What are you expecting when the Federal Reserve meets later this month? And he said, Fed officials 3 rate cuts this year. If you go back a few weeks ago, markets were pricing in more than 5 rate cuts. Now they're pricing in 3. That is what we've thought all along. We'll get a rate cut in June of 25 basis points, followed by one in September and another December. So that's kind of how he's seeing things from a future Fed meeting perspective. But he goes on to say, in a lower interest rate environment, they will give us a slow dance downward in rates. The argument for cutting rates, even if the economy is healthy, is twofold. One, if inflation comes down and the Fed doesn't cut rates, then real rates have gone up. Policy would get tighter than the Fed doesn't want that to happen. 2, Jay Powell has made it clear that if the Fed's target is 2% inflation, they should be cutting rates before inflation hits 2% because monetary policy works on a lag. So he's calling all the things that I certainly expect to have happen here, but it's no guarantee. So we have to be willing to be open-minded enough as investors to any type of outcome, which is why we have the type of cash that we do for our investors. We understand the history of bull markets, and we just laid all the data out for everybody that's watching this program right now. And I'd be willing to bet that none of you knew that information, or very few of you had all the context of the historical data of that. And I go back to the original question that we kind of started out the program here is, what is the value of a certified financial planning professional? One is they are fiduciaries. I am a fiduciary. I have to put my client's best interest at heart. I don't get paid any differently, whether they're in cash or whether they're fully invested in individual equities. I get no kickbacks from any of those ETFs, stocks. Don't use mutual funds, but if we did, wouldn't get any kickbacks for it. None of that stuff. We don't sell commission products like annuities and loaded funds and all that sort of stuff. We are literally looking out for our client's best interest because as the account grows, we're charging 1% annually. I'm getting 1% of a bigger number now. So my objective is in line with our customers. They want to make more money. Our firm would like to make more money as well. And in order to do that, we need to understand how human beings have made decisions, because that is, in fact, ladies and gentlemen, what makes up a market. And if you understand the human beings' behavior before and how they've reacted under similar circumstances, our confidence level jumps dramatically because we feel very comfortable with the probabilities of performance given the asset allocation that we're going to implement based on that historical data. This is the value. This is the X factor that I provide as a certified financial planning professional. This is why you should consider and be open-minded enough to look at a firm like Shepherd Wealth Management as a place to get that kind of confidence. So that's everything that I had here. I don't know where we're at with time as.
We're doing great with time. We're just about hitting the 45-minute mark. So
yeah, that's right about the average duration of our show here. So although I probably could do another 45 on all this historical data, I've got to save something for you guys over the next couple of weeks here. So we try to do these shows every 2 weeks.
on a cliffhanger, huh?
And we'll get back together again here in a couple of weeks, which will put us basically at the end of March, which is crazy. We'll be coming into Q2. I feel like we just got off Christmas, honestly.
Yeah.
So we'll do this in a couple of weeks. And if you really enjoy the program, don't forget to subscribe on YouTube. Hit the notification bell. That way when we drop these things, you're aware of when we do that. And if you're really enjoying all the data that we provide, definitely check out shepherdwm.com. That's where we post our monthly newsletters, our weekly blogs. We do one almost every Friday, as I mentioned. Yeah, hope you guys enjoy the upcoming spring break season. I know our family is with 2 daughters. We got a spring break coming up here, so we'll go see grandparents down in Florida while they're off of school. So you might see me doing podcast shows outside of my office. We'll have to wait and see how the flow of everything goes. But yeah, enjoy the spring break that's coming up for everybody. Enjoy March Madness basketball. I'm very excited for that too. Hope you guys have a great rest of your Thursday. We'll see you again in a couple weeks. Take care.